During the past couple weeks, we've begun talking about recessions. John came first with a video just simply defining what is a recession. And then I talked a little bit about why we're having this conversation today. What's the current environment? And now we want to talk a little bit about what happens during a recession. And while every recession is different, and the next one we have is probably going to be different than the last, there are some common themes and some common things that most Americans identify with recession. And two of those things we're going to talk about today is one, jobs, and two, the stock market. So let's talk about jobs. Currently today, according to our JOLTS data that we have, there are about 11.5 million unfilled jobs in the US that employers want to hire. Currently, there's only about 6 million people looking for work that are unemployed and would like to have jobs, meaning we have a massive, about 5.5 million amount of jobs that we can't fill based on our current population. And what is this leading to? It's leading to something in the past couple of years we've termed the Great Resignation. And that's simply people that have a job resigning for another one in search of better wages or better benefits or a myriad of different things. And what's that's done is forced wages up. And when wages go up, companies have one of two options. Companies can eat that, meaning their profits are going to go lower, or they can try and pass on those costs to their consumers. So far, we have seen companies been rather successful about passing those costs on to those consumers, which has led to some of the inflation that we're seeing today and having to deal with now. One of the main things that the Federal Reserve wants to do is raise interest rates to slow down demand and hopefully convince employers that they should not have to hire as many and bring that job opening number down while still filling the jobs that are available. It's a very tricky situation that they're in. And in some ways, we're seeing that work, and we're also seeing some cracks at the moment. There have been some anecdotal reports from different companies that hiring is beginning to slow. They may not hire as many people as they thought they were going to, and there's been even some hints about layoffs. And generally, when we are in a full-blown recession, we see layoffs begin to accelerate, and many companies lay people off. And we're quite honestly not there yet, and we haven't seen it, and the data doesn't support that's occurring yet. But that's one of the things that can occur during a recession. The other thing most people identify with recession is a stock market decline or a crash or a retreat, depending on how you want to identify it. And while the stock market generally can be lower during a recession, it actually goes down before the recession bottoms. Think back to the first video John talked about. The stock market is a leading indicator. It means it's forward looking. When you buy stocks, you're basically buying the value of the company today plus your share of the future profits. So if you're buying it today in advance of a recession, the price should be lower because you think the profits are going to go down. But if we're in a recession and we think we're changing the corner, we're going up, profits should be higher. Therefore, the stock should begin to rise. And generally, the market will bottom before the economy does and begin to rebound. That's one of the reasons that when you're in a recession, many people or many advisors may come to you and say, hey, it's a good time to buy. We need to do this. And it's at those moments that it can be scariest to do so. But we want to take a look at that and just give some advice on what you should expect if the economy does go into recession. Now, our base case is that we're probably scraped by and we won't have an academic recession this year, but it still very well could happen. We want to talk about those things. Next week, John and I are going to have a simple Q&A about what investors or Americans should do in preparation for a recession, or if we already are in one, what they can do to look forward. So you guys just want to stay tuned and look forward to that. Thanks.